It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFT studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
The Roth IRA is a fantastic and versatile tool for your financial future. However, it also has some unique rules that can cause confusion and uncertainty on how the Roth works in specific circumstances. So we're going to address that and many questions from fans of the show on this show.
Yeah, the Roth IRA, I get teased a lot. It hurts my feelings. If you would like to start a support group or want to talk about it, I'm here. Just reach out. No, I'm just kidding. It is a fantastic tool. And so you got to work with your CFP. We're going to help you understand a little bit more about it on today's show. If you have a question for the program, we'd love to hear from you. We're answering just questions from fans of the show today. You can call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can submit questions. Most of these questions, maybe half of them, came on the YouTube channel. You can leave questions there. So find us on social media as well. Just engage with us that way. Leave questions there. So I love the Roth. I love it. Guys, I always say that. I love it. And then I also say, but it's not one size fits all. This is one of the quintessential financial planning decisions you need to make. And when if you're on board with that, you might say, okay, I'll get some advice. I'll make the decision. And then I'm good, right? No, you have to reevaluate or re-answer this question at least every year. But technically, every time something materially changes in your financial life.
Mm-hmm. That's exactly right. And a lot of times we frame this decision as a choice between using a traditional tax shelter like an IRA or your 401k at work or a Roth account. And they are treated basically opposite of each other from a tax perspective. The thing that we love about the Roth IRA, though, is it's one of the only places that you can start to accumulate dollars, get it invested for the future, get it compounding and growing like crazy, and the growth is tax-free to you. Mm-hmm. And so, boy, if you have an opportunity to allow money to sit in a Roth IRA and grow for years, maybe decades, the longer that it's simmering in that crock pot, the better, right? Because the more growth that is accumulating over time, you can get to the point years out in the future where the growth is multiples of the money that you put into it.
You know, I did a show or I did a YouTube video on this. On average, going back about 100 years, $100,000 in the stock market. Now, you're probably diversified. You might not be taking this much risk. 100,000 30 years later becomes 2.5 million.
Wow.
On average, looking at rolling 30-year time periods. So
that's
yes,
amazing.
Leave it in that crock pot for a long time. And imagine all of that growth being tax-free.
Yeah. So the $100,000 that you put into that Roth IRA, let's say, that was money you already paid tax on. That's the cost basis, as we would call it. Money you've already been taxed on once. You're not going to be paying tax on that again in the future. But the growth, that the remainder, what did you say, 2.5 million?
Yeah.
So 2.4 million of that Roth IRA out there in the future would have never been taxed along the way and never will be because the growth and your contributions come out tax-free to you.
And think about this, guys. And this is, musings of Mike Bernard. You can catch it on the YouTube channel. But think about that. You somehow find a way to save up in a Roth $100,000 by the time you're 35. You hustle. From 25 to 35, you save up $100,000. 30 years later at 65, it's this gargantuan amount and it's tax-free. But it doesn't stop growing tax-free at that point. Mm-hmm. You still have another 2 to 3 decades of growth of your retirement, and then it doesn't. The music doesn't stop. There's then another 10 years after that. These dollars could be growing tax sheltered for nearly a century. That's unbelievable. Capture the power. So how do you use it? You can contribute to a Roth. Okay, how do you contribute to a Roth? You've got to have paycheck money, as Josh says, earned income. But you can't have too much income. Total adjusted gross income, I think this year you're capped out, or you're beginning to get phased out at around $246,000. I don't have the number right in front of me. Married, filing jointly, 126 or so around there, single. So that's contributing. Have to work, but your income can't be too much. The second way to get money into a Roth is to convert. Move some of your previously contributed pre-tax money over to the Roth side. That's a taxable event, but there's no penalty. So there's two ways to get money in. And then that tax-free growth, you've got to have had a Roth for 5 years, and you need to be age 59 and a half.
And you know what? That decision, I'm glad that you framed it as at least consider the Roth contribution or the Roth conversion on an annual basis, but maybe you need to revisit it more often as there's some sort of material change in your tax picture, your income picture. And I was just meeting with some clients this week who are approaching retirement, and there's probably going to be a significant enough change in their tax picture that all of a sudden, really for the first time, Roth conversions are going to make sense in their situation. And I kind of framed it to them as something that we have to be considering, because if you could pay tax now in a known tax bracket and avoid them in a future tax bracket that we believe could be higher, then that's how you win with a Roth IRA, right? It's about positioning, when do I pay taxes? And, we were talking about, well, what could cause someone's tax picture or their tax brackets to be different in the future? One is the laws change for you. Maybe you have some surprise income in the future that throws you into a higher tax bracket. Or the more sad and somber, tragic scenario would be one of the spouses passes away. And you go from filing a joint tax return to a single tax return, and it just doesn't take... It takes half as much income to get into those higher brackets in those cases. So if there's a chance that in the future you could be in a higher tax bracket than you are right now, you got to be thinking about the Roth IRA.
Yep. And you got to be careful too, because the two ways to get money in, contribute or convert. If you're doing a conversion, that's going to change your income. And you have to look at the downstream effects of changing your income beyond just paying more income taxes.
So those are the high-level rules, and I'd like to say those are generally simple. They're not, but we can kind of get that. But just beneath the surface of those rules are a whole bunch of unique circumstances, idiosyncrasies, and other hard things to understand that many financial professionals still squabble about. The IRS rules aren't clear, and it just creates a whole lot of questions. And so when I look at the questions that we receive from the fans of the show, so many of them have to do with these unique rules around the Roth IRA. So rest of the show, we're going to be talking through questions, Q&A about the Roth IRA. First one, coming from a fan of the show, Dirk. Here's what he asked, 2 questions. I have a question that might be related to many of your listeners. I have a traditional IRA from years ago with pre-tax money in. I also have a Roth from years ago when I was eligible. I'd like to now do a backdoor Roth, but don't want to intermingle pre-tax and non-deductible money for the backdoor. Is it allowable for me to open a second traditional IRA and fund that with the non-deductible money and then do the backdoor Roth just from that account? And then second question is, hey, can you help me understand and explain what the 8606 tax form is?
Well, so, to go straight to the point on Dirk's question, yes, you can open up lots of IRAs. There's no rule on the limit of number of IRAs that you open. And you can, earmark one of those IRAs as the place that you're going to make some deposits on an after-tax basis, some already taxed money that you plan to convert into the Roth IRA. We call that the backdoor Roth contribution. The problem is it's not going to achieve what I think you're trying to achieve, Dirk, and that is, if I just convert those dollars that have already been taxed, then my Roth conversion, creates no tax for me, right? No tax, no penalty, anything. The problem here is that when you do a Roth conversion, we're going to look at all of the IRAs kind of in aggregate to determine what are the tax consequences of this maneuver.
And it's not we or up to someone's feelings that day. This is the IRS rule, and it's sort of illogical, but this is one of the things that they've used to sort of clamp down on this strategy that, it's all IRAs are aggregated, and you're looking at the proportion of how much after-tax money, how much pre-tax money. And so you can't just open a separate IRA and just convert that and circumvent those rules. We're going to get a little bit deeper into that and then answer the second part of Dirk's question. That and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning. Also on podcasts at the same time, but also on a couple local radio stations at the same time as well, which is why it's long form A, which is why there's segments B. And it doesn't maybe have a perfect podcasty or YouTube feel, but that's okay. We've got Next Rise Step videos that air all throughout the work week. Lots of other content on the channel, over 1,600 videos as well. So odds are in every single one of these questions, we've created at least one or two other pieces of content exploring it. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, like the content. Thank you very much. Many have tried and many have thought this is the case. I bet many have done it wrong, have no idea.
Dirk's strategy of segregating the pre-tax versus
after-tax. Because it's logical. Mm-hmm. It makes sense.
Yeah.
The rules are what don't make sense. Mm-hmm. And yet, in this weird, bizarre way, I sort of get why the IRS came up with these rules. Mm-hmm. All right, so we'll go that and then 8606. That'll take a few. I've got the IRS page up on what the 8606 does.
Do we talk about a strategy for moving the pre-tax money into a 401k?
Could. Yeah, I mean, we can go as long and wide with each of these questions as we want. Okay. So, all right, here we go. Do you have a Roth IRA? Have you ever done a Roth conversion? Have you considered it? Are you working with your CFP on this? If so, not that you need to be an expert in the Roth, but you do need to understand some of the idiosyncrasies and how it works. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Roth IRA Q&A. All questions from fans of the show relating to the Roth IRA. First one here from Dirk saying he's no longer eligible to contribute directly to a Roth IRA. That is, he makes more than that income limit, which I don't have it in front of me. I think it's 246 and married filing jointly, and then 126 single, somewhere in there. You have to have earned income, but if you make too much, you can't contribute directly to a Roth. So what's the backdoor way around that? Contribute to an IRA, but you make too much to deduct it. That's okay. It's after tax. And then you convert the after-tax money to the Roth. Here's the problem. If you already have pre-tax money in an IRA anywhere, except for an inherited IRA, but I mean SEP IRA, simple IRA, traditional IRA, you can't just pull the after-tax money out. Once the sugar is mixed into the brownie batter, you can't just pull the sugar back out of it. Mm-hmm. So
that's exactly right. I was going to use a similar analogy. I've heard someone describe that most traditional IRA accounts have money in it that has never been taxed. We call it pre-tax money. It's never been taxed. It's going to grow and grow without being taxed, and eventually you'll pay tax when you pull it out in retirement or when you pull it out to do this Roth conversion that we're describing. If you think of that like coffee and you think of after-tax money like creamer, as soon as you mix the two, you really can't separate them back out when you're doing a Roth conversion, except one strategy. Mm-hmm. And that is to get all of your pre-tax money, your traditional IRA dollars that have never been taxed before, just get them completely out of an IRA entirely. And what's one way that you can do that? Really, the only viable way that I would consider is moving it into a 401k. Your 401k at work is allowed to receive money from an IRA. You can roll money into an employer-sponsored plan like that. And in doing so, you now have completely removed the coffee and you've only got creamer left. And so when you go to do this Roth conversion, we don't have this commingled, mixed up mess that could create taxes and penalties for you.
For the record, Kevin and I love coffee.
Yeah.
And Josh doesn't.
Never touch the stuff.
So.
Yeah, I don't think you should be using a coffee analogy, Josh.
Yeah, you haven't earned it,
Right.
Josh.
It's like saying crunchy peanut butter. Okay, so just a good example is if someone had $300,000 in a traditional IRA and they had an employer-sponsored plan that was subpar. And they said, look, I don't want to roll this money into my employer-sponsored plan. What should I do? One of the strategies is to say, well, listen, make after-tax IRA contributions to that IRA. And you say, wait a minute, I just poured cream in the coffee. Yes, I did. I just put peanuts in the peanut butter. Yes, I did. And you're like, well, I can't separate that out. You can, because what you can do at the end, you're tracking. One of the questions is, what is the form that tracks my basis? Form 8606. Yep. So you make these contributions, and just to keep it simple, over time I put $100,000 of after-tax money in, and there's $400,000 of pre-tax money in my IRA. You roll $400 into your employer's subpar plan right before retirement, and then you convert the 100 to Roth IRA.
So there's no tax on that conversion because it was all after-tax money.
Correctamundo.
And all of your pre-tax money is now in the 401k, but you're not going to leave it there long because you're retiring soon, and then you'll roll it right back out to an IRA, you're saying.
Yes.
Yeah.
Love it. That's good.
You've got to track your basis on these sorts of things. So your basis, we're going to get into this with 5-year rule. You got to track how much after-tax money you've thrown into your IRA. You've got to track your Roth conversions. And how do you track that? Just on an Excel sheet or a ledger? And that's going back to that 8606, the second question that Dirk asked. On the 8606 form, this is completely voluntary. You don't have to fill it out. But if you have one of these things, you ought to fill it out. And your CFP or really CPA that's helping with your taxes should not skip this. If they do, it's going to could create some challenges out there in the future. Non-deductible contribution. So after-tax contributions, that's tracked on your 8606. Withdrawals from IRAs or SEP IRAs, if you've ever had any after-tax money in there. It's going to track your Roth conversions and track distributions from your Roth IRA as well. All of that on that Form 8606. It's not required as part of your tax form. So even if you should be filling one of these out, you might have skipped it, you might have missed it, your tax preparer might have skipped it. Don't do that. Don't do that. So.
Yeah, it's possible that your taxpayer or tax preparer rather doesn't really even know exactly what you've been up to with your investment accounts throughout the year. Right?
We've done a few videos on this and some other interviews and whatnot in media space about this. Many companies are not issuing 5498s anymore. So,
but even if they do, it doesn't come out until May,
right
after you've already prepared your taxes.
Why not?
Because they're lazy. They're lazy.
Well, it's because you could still be contributing to your IRA or Roth IRA up until...
I know, but a lot of companies are like, nope, we're still not doing it. Still not doing it. Yeah. Yeah.
Well, they can do that.
So you say, why does it matter? Here's why it matters. If I put $100,000 because you think, going back to the after-tax IRA strategy, I put $100,000 in, it's all after-tax money. If that isn't tracked, if that basis isn't tracked, when that money comes out, I'm going to pay taxes on it again. I mean, the only thing worse than paying taxes on your income is paying taxes on it a second time.
Yeah. All right, here we go. We're going to keep going with these questions. And this, we've got a couple. We have lots of them that deal with the 5-year rules with Roth IRA, and it is confusing. There's actually 3 5-year rules, okay? We've done shows on this before. Lots of these questions come from these shows. The first 5-year rule question we're going to hit, here we go. I enjoy watching your YouTube videos and specifically about the 5-year rule on Roth conversions. I'm 70 years old. My first Roth IRA was open more than 5 years ago when I rolled an old Roth 401k that I had into it. I then have 3 other Roth IRA accounts, so 4 total. One created from a Roth conversion in 2020. the other from a conversion in 22, and the last from a conversion last year, November of 24. I'm seeing people suggesting that all Roth withdrawals must wait 5 years from the creation date. In other words, each of these Roth conversions has its own 5-year waiting period, and if I combine all of them, I restart the 5-year rule. There's so many questions here. Some of them there is no clear answer on. The first one is clear. You contributed to a Roth IRA more than 5 years ago. You've met the first 5-year rule. You've had a Roth for at least 5 years, so you're good there. That first contribution, however much it was, however much that balance is, you've met the 5-year rule. You're now over age 59 and a half. You're good with that.
Which means this. The contribution amounts that you put into that account, those have always been accessible to you tax-free. But now the growth that has accumulated will also be tax-free. And the fact that you're over age 59 and a half means it's penalty-free as well. So you've checked all the right boxes. Your contributions are fully accessible to you. No problems.
All right. The second part of the question, we're probably going to hit a break while we're in the middle of this one. The second part of the question is these Roth conversions, the three of the Roth conversions, yes, they do have their own 5-year rule. Okay. So you do have to do that 8606 and track all that 5-year rule. However, because you're over age 59 and a half, the first part of the 5-year rule is really is a moot point for you, because and we're going to get into this a little bit more, but part of the 5-year rule for Roth conversions is to keep you from finding a loophole avoiding the 10% early withdrawal penalty. Well, as soon as you turn age 59 and a half, or you're fully total disabled, or someone has passed away, it no longer applies to you. So that part of the 5-year rule, once you turn age 59 and a half, the part of the 5-year rule for Roth conversions does not matter. Does not matter. The second part could. We're going to get into this here in just a second. But because of how the rules work with first in, first out with Roth IRA, very rarely would it apply. So we are in the depths. We are in the weeds. We're going to circle back to it and answer more questions here on the Wise Money Show with Korhorn Financial Group. Check me. I know, like, using lots of words, but am I on the right path? Is this clear enough?
I heard you say anything.
Yeah, this is the advanced class, though.
Yeah. I know, but
for a show about financial planning,
because you guys are awesome. Like, you should see how many questions
I know.
about
I see
this
the questions.
very thing.
I see the questions, and I think, oh, that's
Very
a
detailed.
4-paragraph answer.
Yeah. All right. So third segment here. Let's pick that back up, and then the third question is: when you combine the accounts, do you reset the 5-year rule? And that's the one I've never heard of that. I do not think that's a rule. I've never seen that rule.
I mean, I could see how you would fear it, because if you take a distribution, 2 years after consolidating, who's tracking the history, right? And the proof that, no, this money really has been around for 5 years, or it's been converted for more than 5 years, or whatever.
But that's the one I think we can say I don't have that answer. I don't think so. But all right. Okay, here we go. We'll pick this one back up. And then, all right, here we go. The 5-year rules, yes, there's more than one that relate to Roth IRAs. Guys, they are confusing. They're confusing, and creates a lot of questions. We're helping with that right now, but it's no substitute for you getting the individualized planning and advice from your CFP to work through your specific situation. We're helping with Roth IRA Q&A right now. This is a Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen to podcasts, just search the Wise Money Show. Subscribe to it there. Follow us there. Rate the program there as well. That's helpful feedback for us. We appreciate it. All right. So, yes, hitting questions from fans of the show about the Roth IRA, specifically 5-year rules. I have a lot of questions. A lot of questions. We're into one right now that has 3 different layers to it. It deals with Roth conversions. Each Roth conversion has its own 5-year rule. But once you turn age 59 and a half, the basis, the amount that you converted, there's no longer a penalty that would apply to that, even if you withdrew that converted amount within 5 years. That penalty, that 10% penalty, applies if you're under age 59 and a half. Because say you're 40 years old and you are needing to make a withdrawal, you want to take money out of your IRA, but you're aware, I've got to pay tax and this penalty. I know what I'll do. I'll convert the money from my IRA to my Roth, and then I'll withdraw, because my converted amount, I won't have to pay the penalty on it. No, that's why, nope, you got to wait these 5 years. Mm-hmm. So once you turn age 59 and a half, that first part of that 5-year rule on conversion is a moot point. The second part, there is inconsistency on this. We would believe that the growth on that conversion could be taxable if you withdraw the growth within 5 years, even if you're age 70 or after age 59 and a half.
That's right.
But a lot of financial advisors, I'm not going to say financial advisors, most financial advisors cannot keep up with this conversation, by the way. So kudos to you if you are. But most tax experts and IRA experts would say, yeah, but really that's a moot point, because dollars, when you're withdrawing money from the Roth, it's first in, first out. And therefore, you'd really have to withdraw your entire Roth IRA and be able to see that there is growth in it all within 5 years. And if you're doing a Roth conversion, and in your mindset is, let's have this money, let's pay the tax now to have this money grow tax-free for decades and decades to come, it's unlikely you're going to withdraw your entire balance and close all your Roths.
So now we're getting into just real world application, right? Mm-hmm. Because if you want to be a black belt in financial planning or tax preparation or anything like that, you have to know these 5-year rules, because they represent a potential gotcha where you could mess things up. But the reality is that if you're working with a certified financial planner, most likely you're using a strategy like contributing to a Roth or converting money from an IRA to a Roth, all for the purpose of getting that maximum growth in a tax-free environment. And so you're going to be probably holding this Roth far longer than the 5-year rule even applies. That's part of the reason why, I'll just speak for myself. I don't bump into 5-year problems with Roth IRAs with most clients, because I'm intentionally steering them away from a 5-year time horizon with their Roth accounts.
Absolutely.
Right?
Yeah.
But life can throw you curveballs. Sometimes you need to access some money in a Roth. And that's where you want to make sure, before you were to take action on any of this, am I... as the carpenters say, measure twice, cut once, right? Mm-hmm. I want to review these nuanced rules in detail with my certified financial planner to make sure that I'm not, stepping in the wrong spot and injuring myself here.
Yeah, and I don't think of the carpenters, I think of the watchmakers, because the question is, do you want to know how to make a watch? And because we're telling you how to make a watch, or do you want to know what time it is? Mm-hmm. And most people deal with this. It's so seldom that they deal with this, because I look at these detailed questions and I think, what a fantastic question. But even if we gave the perfect answer, if it was the perfect phone call, if it was the perfect answer, would the person remember that 2 years from now?
Right. This is so obscure.
Yeah.
Yeah. And then the final part of the question is, she's done 3 Roth conversions. The first one was done in 2020. You've met the 5-year rule, because the conversions, even when you do it during the calendar year, it's as if it happened on January 1st. So you've met the 5-year rule with that. But she talked about, well, I've got each of these Roth conversions in separate accounts. If I consolidate them, does it restart the 5-year clock? I've never heard that before. I can't. I would say I can't answer that. I wouldn't think so. You're tracking it on an 8606. It's not being tracked by the individual company. They actually don't care. Vanguard doesn't care. It's your tax return. So I wouldn't think that.
And can I just say they don't care?
Yeah.
You would think they do, and you would think if this is important stuff to be tracked, someone would be looking out for me. Like, who's looking out for me?
Yeah.
No, they don't care. And some of these companies have gotten better, but I remember when I first got in the business and someone wanted to sell a stock, and so you would ask them, what's the basis? And they're like, I don't know what the basis is. You guys sold it to me. You tell me what the basis is. And I'm like, well, we don't know what the basis is. So some of these things that are your responsibility, you want to understand. What am I responsible for, and what are the professionals that are serving me responsible for?
We did a show early on. We've been doing 10 years of the Wise Money Show. Congrats, guys. And early on, I think it was year 1 or year 2 when it was really bad. I mean, you think it's bad now. It was really bad back then. Did a show about a unique 5-year rule with the emergence and growing popularity of the Roth 401k. And we still get hecklers because people don't like the actual answer, as if we made it up. Now, of course, the Roth 401k has grown in popularity, so this question is more common. Here's what David asked. If I had a Roth 401k, but not a Roth IRA, and I'm 60 years old, and I move my Roth 401k to my Roth IRA and start pulling money out, did I satisfy the 5-year rule? No. The Roth 401k has a 5-year rule. The Roth IRA has a 5-year rule. They do not share the rule. You have to hit, if you're going to withdraw, whatever account you're going to withdraw from, you got to have had that account for 5 years and be age 59 and a half. I know. I'm going to say that doesn't make sense. I'm going to say the IRS didn't intentionally decide to do that. But that's how it works.
Mm-hmm. That is part of the problem. You know, as Congress is making rules and everything, there are a lot of retirement plans that have similarities to them. You know, IRAs are a similar, tax shelter to a 401k. Contribution limits are different. How they function are different. And they are created by totally separate areas of the tax code. And so as you start tinkering with these rules, they may not always align and they may not always be logical. Mm-hmm. But this is part of the reason why having a certified financial planner in your life to not just understand the rules, but know the strategy of the game that you need to be playing. Right? Mm-hmm. Which tools do you need to be using along the way, and what can you do to avoid backing yourself into a corner? You know, in this example of, hey, I've got money in a Roth 401k, and I've had it for more than 5 years, but I haven't had a Roth IRA for more than 5 years. Well, what if your certified financial planner was looking out ahead and said, hey, let's get the 5-year clock ticking on a Roth IRA for you, so that we've got both of these accounts accumulating their 5 years of qualification. You don't have to have a lot of money in that Roth IRA, right? You could just dump a few bucks in there to keep the account open and just start accruing your 5 years. But it takes someone in your life working with you to look down the road, not just be, well, as we always say, we don't want to play checkers, we want to play chess, right? Be thinking multiple moves ahead. And that's really what a financial plan, a planning approach does for you.
Yeah, and in these, with some of these questions, it's 3D chess, and we didn't create the board. So, but here's the thing, part of the other part of David's question. So, can I withdraw from the 401k the Roth 401k at age 60? Yeah, yes, you can. You've met the 5-year rule there. But we would tell you, just like Josh said, as long as you still have paycheck money, earned income coming in, and you're eligible to contribute to a Roth, even if, throw $50 in a Roth IRA, get that 5-year clock started. So then you steer clear of this, and you don't have to worry about it. I mean, think about how much stress and frustration has been energy burned on worrying about 5-year rules when it's unnecessary. Just get past it. Don't ever think about it again. And tell your kids to do that too. My goodness. All right, we've got more Roth IRA questions from fans of the show. That and more coming up on the Wise Money Show with Korhorn Financial Group.
Is this third segment?
Fourth.
Man, I am always off.
Mm-hmm.
I think I slept through one of those.
I put you to sleep.
Well, it was...
No, I was talking at the time, I'm pretty sure.
Easily done.
All right. So we might not get to the super weird rollover one. We probably will, now that I mentioned that. But first one, we've done a show on this. We're going to talk about it more, but that is an individual who loves the Roth so much they want all of their money to be Roth. and we'll talk about, hey, don't be
too
fixated.
aggressive.
Yeah, don't be fixated on that. So, anyway, so we might get to both of these. We'll see. But fourth segment, land in the plane. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out, as well as a lot of other videos as well. Go to YouTube, search the Wise Money Show, subscribe to it there. Turn on notifications so you're aware every time we drop new content, which is typically 6 videos a week. And you can leave questions, you can share videos, all that sort of stuff. So go to YouTube, search the Wise Money Show. Talking about questions, common questions, unique issues related to the Roth IRA, 5-year rules we just hit, and a lot of strange stuff. But again, as I mentioned before, this is no substitute. Your specific financial situation, you might think, yeah, I'm very similar to my coworkers, my neighbors. We live a very similar life. I'm sure their situation's just like mine. You have no idea how unique your financial life is compared to the person that you maybe look like, maybe you grew up with, maybe you have the same job and the same perceived income as them. Your financial situation is so different and so unique. And here's the thing, we've done shows on this before. No one knows it. No one knows it. Your wealth is private. It is secret. Work with a certified financial planner. They want to help you as a fiduciary, help you understand and navigate these very complex rules to get you from where you are to where you want to be. Confidence, clarity, creativity. All right. Roth IRA. Next question from Diane. I turned 58 in January, and I have been contributing 50% pre-tax, 50% Roth. Okay. After watching your videos, I've shifted to 75% Roth this year, plan to shift to 100% Roth next year. See, guys, this Michael, Paul, Roth, Bernard, it's working. I'm moving, and we're painting the whole country. Roth.
You've gone too far, I think.
Okay, the question is, Diane, have you gone too far? Because here's what she then asks. When I convert the last 10 years of traditional, what and should I take in? Should I do that in different steps? Should I convert it all at once, or should I do it in different steps? My husband and adult son are on disability, so I'm the primary source of income. We live week to week. Okay. So first off, make sure it makes sense to be fully Roth. Mm-hmm. Make sure it makes sense to be fully Roth. I would have said, if you would have stopped your question at, hey, I'm doing 50-50, is that the right thing? I would have said, make sure it's the right thing. Mm-hmm. Okay. But now make sure, even though the Roth is great and very versatile and all of that, make sure it's the right thing for you.
Yeah. We would all say, man, having some money in a Roth IRA, what a good thing. Having a lot of money in a Roth IRA, what a great thing. Mm-hmm. What about having all your money in a Roth IRA? Is that a great thing? Is it even a good thing? Mm-hmm. And yeah, I can tell you, man, there have been some clients who they get just totally dialed in on the Roth. And before you know it, after doing conversion after conversion over the years, they've just got so much money, and maybe even all their money. And they may have actually ruled out some great tax planning for themselves in the process. And I'm thinking about people who, especially those who are charitably inclined. Mm-hmm. If in your retirement you have, or throughout your whole life, you've always supported your local church, you've tithed on a regular basis, maybe you support your alma mater or some other really important mission or organization that's a charity. When you contribute money from your traditional IRA, money that's never been taxed before, if it goes straight to that charity after age 70 and a half, you don't have to pay tax on it. You don't have to even count it on the tax return. It's called a qualified charitable distribution. Well, you don't get to do that when you're using Roth dollars. Mm-hmm. So unfortunately, you're having to contribute to this charity or this organization money that's already been taxed along the way. Mm-hmm. Or what if you have a bunch of IRA money and you pass away and you want to leave a chunk of money at the end of your life to one of these charitable organizations? that's a wonderful way to leave money behind because you never paid tax on it during your lifetime, and the charity won't pay tax either. But that idea goes away when you've already gone and paid tax on it all yourself.
Mm-hmm. Yeah, we have a number of business owner clients that they are putting all their money into their retirement plan pre-tax with the intentions that this is going to be what they're going to be charitable with in retirement. So they're never going to live on their 401k. They're going to have an event or some other assets that they have will take care of them in retirement. So they're just going to use that for charitable.
So they'll roll it out of the retirement plan into an IRA, and then they'll do qualified charitable distributions.
Yes.
I have similar clients where they have the beneficiary named on the account as this charity. So if they pass away unexpectedly, they know it's going there.
Yep. And the only thing I would say is just be careful because in the last few years, a number of these charities have changed. And so you might not recognize them. When the organization that I used to take my boys to when they were growing up, it was called Boy Scouts, and it's not called Boy Scouts anymore. It's totally different. And if you are dialed into those changes and you agree with them, then it's fine to have that in your estate plan. But if not, I would be checking right now and saying, do my values align with the values of these organizations?
Go ahead, Josh.
Well, that hit me, that comment, because it just emphasizes why it's so important. You were talking about how your estate plan needs to be kept up to date, and it can change over time. But the laws can change, right? Like tax laws can change over time. You don't have to go back very far into history before you get to a point where this idea of a qualified charitable distribution didn't exist, right?
Yeah.
And so we're always talking about leave yourself in the most flexible, nimble spot financially. And having money in both IRA and Roth IRA might be the solution there because you never know what kind of opportunities are going to present themselves down the road as life changes.
Two other points haven't been mentioned yet. One is your standard deduction every year. And again, these tax laws could change. The standard deduction has doubled a few years ago, could get cut in half and go back to the way it was. I don't know. But every year you get a certain amount of write-off. And if you've already paid tax on all that money, then the write-off could be essentially useless. That's one thing to be aware of. But then the other is you mentioned husband and adult son are on disability. So what other sources of income will you have in retirement? If it's mostly going to be Social Security and you want to make sure that Social Security is not taxable under current laws, I get the idea of having the majority in Roth because it's a very slippery slope, can't stand the rules around taxation of Social Security. So that's one thing to consider. And then the other is when you look at your sources of income in retirement, do you anticipate any inheritance dollars? Because if it's possible that you're going to get a wave of inheritance dollars, even close to six figures, that's all pre-tax. That also might say, okay, nope, let's really load up on Roth. And that influences how quickly you should convert and so on. Laying out that schedule, I'd work with your CFP. Make sure it still makes sense. One, lay out the schedule with your CFP. Consider, look at this from all different angles and map out the right plan.
That's a hard thing for people in their own planning for their retirement to have enough of a sense for what other people's financial lives could either create for them or change their picture. So, to the extent that your family is open and just really communicates well on finances, if your parents are still living, you may want to have a conversation with them just to understand what's going on in their financial life and what could it mean for yours as well. Because, as you said, maybe you need to be proactive with converting your own IRA dollars to Roth so that you have maybe 50-50 after an inheritance.
I'm going to sneak this one in. It's my least favorite question because I don't even have an answer. But question from Mark, is there a limit on how many indirect rollovers to a Roth IRA you can do in 12 months? By indirect, I mean I'm withdrawing money from my 401k, withholding taxes. They send me the check, and then I put it in my Roth IRA. That is a rollover. You have 60 days to do it, and you're only allowed one of those every 12 months, not once a year. It's every 12 months. And so I'm saying the fact that you're combining this with a Roth conversion still makes it a rollover. And I'm saying that once every 12 months would still apply. I'm certain you're seeing mixed messages on this, though, because I think this is very unique. I would do an in-plan Roth conversion. I would avoid this risk fully and not make it a rollover conversion. Just convert. Keep it simple. Here's the idea. All these complicated questions and idiosyncrasies with the Roth, work with your certified financial planner. Leverage this amazing tax tool to the greatest advantage for your specific financial situation. It's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.